It's the philosophy of that rugged individualism, the independence, and the ability to really get things done for yourself and control your own destiny. You get that from a blockchain, and you don't get that without it.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Not lost on many of you that the very moment Ray Dalio of Bridgewater says cash is no longer trash and the defiant equity market bulls over at JP Morgan start to crack, that this market starts to rip yesterday and again this morning. Good morning to you. Equities up on the S&P 500 by 1.5% or so, on the NASDAQ up another 2 percentage points, driven by what's happening in the bond market, arguably, with yields dropping ever lower, 2s, 10s and 30s. On a 2-year last week, 4.35. On a 10-year last week, 4%. Right now, 3.58 on 10s, on 2s, 4.02%. So the 2-year now is where the 10-year was, I think, last Wednesday. Yields down by about 5 basis points on a 10-year, down by 8 or 9 at the front end of the curve. So yields down, equities up, and guess what? The dollar weaker for a 5th straight session. If we close weaker here, TK, longest losing streak for the dollar index going back to September of 2021.
In the literature you're reading, is it a regime change? I don't see that yet, John.
Too early, TK. Yeah, too early. But certainly what happened with the RBA a little bit early this morning has fueled this conversation about peak rates, peak dollar, peak hawkishness.
Absolutely. It was going before, but Australia was doing 25 beeps, not 50 basis points, folks, was the, like you say, the fuel off the Pacific Rim.
Though, as Bramos pointed out several times this morning, she's right to frame this, to push this argument, because many people are on board with it. The more this market rallies, the more likely it is that this Fed is not going to back away anytime soon. That's the cross-asset price action. Let's get you some single names and say good morning to Lisa. Morning, Lisa.
Hey, John. The single names are basically a continuation of the story that you're telling. Which names do best in the regime that you're talking about, of a Fed potentially backing away, potentially pivoting, if you want to use that word, from some of the aggressive rate hikes? You see big tech doing really well, standing out. Amazon shares up nearly 3%. Apple shares up to nearly 2%, the same as Facebook's parent company, Meta. This comes even though Meta is saying that they're going to be a smaller company next year than this year. It comes even though Apple is facing a number of headwinds with the semiconductor space, indicating a much slower pace of demand. And this comes even though Amazon.com is going to be at the crosshairs of less consumer activity if you do get some sort of pullback in consumer spending. This raises a lot of questions. Are we just seeing the high flyers fly once again in a knee-jerk impulse of this market to basically go into the high beta tech names as the next leaders of this market, the same as the old, even though a lot of people are saying this isn't going to be the case? And what you're seeing with Rivian, which is this electric vehicle maker, to me, really symbolizes what you're seeing. These shares are up nearly 9% because they indicated that they're actually producing more than expected. This comes after Rivian disappointed quarter after quarter. The shares are down more than 60%. How much are we seeing sort of the last gasps of the old playbook, Tom, rather than the creation of a new one in the face of a very different regime?
It's a toxic brew right now in the equity space. I would point out, Lisa, Apple off the August peak, down 18%. This is an exceptionally important conversation for Global Wall Street. Working with Jason Trennert, it's Strategas, taken out by Baird, is Thomas Sitsoris. He's head of fixed income research here and combines economics and mathematics like no one. Tom, I'm going to cut to the chase and go Fibonacci 101 on you, which is which matters right now, the nominal yield or the real yield? Which should we study?
Oh, definitely the real yield at this point in time. I mean, basically, that's your indicator of how tight liquidity is getting, and real yields are still rising, at least as of last Friday.
they're rising as of last Friday. The 10-year real yield has come in. Which duration of real yield is the most valuable for global Wall Street?
For financial assets, absolutely the 10-year part of the curve, 5s to 10s in general. If you're talking about Main Street economy, you're talking about more like 1 to 2 year part of the curve.
I mean, I look at the spread that we have, and as John mentioned with Citigroup, the importance of economic data, the jobs report, to guessing the Fed parlor game. Do you agree that economic data dependency now is critical in your fixed income space?
Yes, and typically under normal circumstances, we're most worried about that labor market report. I focus on the average hourly earnings, but you could look at employment costs. But that Friday average hourly earnings is always the most important data point, I think, in any given month, but especially so now because inflation is still sticky. Core inflation is around 5.5% to 6.5%. That's where wages are. That's got to come down for the Fed to eventually pivot. Until that comes down, I don't see a Fed pivot.
Tom, you know the conversation this morning. It's frustrating for many. Equities up, yields down, peak Fed, peak hawkishness, the RPA's blinked. We're getting carried away here. Does this rally make it more likely the Fed goes 75?
I don't think it makes it more likely the Fed goes 75, but I think what the market is saying, first of all, we're looking at a classic short covering here, both in equities and bonds. Positioning had gotten stretched last week. The Bank of England has, for the time being, has blinked already. And so the market is saying, well, now we've got a weak manufacturing report. The Fed's going to be blinking soon. And I don't think that's necessarily true. But I do think that the rally is telling us that there are certainly investors who were short before who are worried the Fed is going to blink. So I don't know if there's a direct correlation just yet. We got to see that Friday labor market report first.
So what would you be doing in a situation like this, especially given the volatility that we were just talking about with Amy Wu Silverman?
Well, on the fixed income side, we now need to be tactical duration. That is, you have to be actively managing your duration exposure. You can't just be forever short duration, forever long duration. You also need to be managing tactically your credit risk exposure, particularly in the high yield side, but also in the investment grade side. But we're looking at sell-offs in bonds as a time to buy and deep rallies as a time to sell.
And what exactly are you buying? I was looking at a Bank of America survey of investors in the debt space, and they actually were more underweight investment-grade credit than high yield, basically saying they're not going to see a default cycle akin to what they have in the past, that instead this is going to be rate-driven and dislocating borrowing costs for companies around the world, just regardless of the rating.
Well, I think that's what we've already seen so far. We've seen a rate-driven sell-off in investment-grade credit, which has, for the most part, spared high yield, particularly the energy-focused space of portion of high yield. But that's going to change in 2023 as the economy looks like more and more like it's heading towards a recession. So we're going to go into a classical, more typical credit cycle with earnings contraction as well.
What does your world mean to Jason Trennert, who founded Strategas out of Ed Hyman's shop? What does the thesaurus world mean for Jason Trennert in his enthusiasm on American equities?
Well, basically the way I phrase it is the world's most important financial indicator is the 10-year Treasury, and that's going to feed into your equity multiple. On top of that, you're looking at essentially real yields, as we talked about earlier, being a drag on essentially nominal earnings, not just real earnings, but nominal earnings. So they both feed into both portions of your equity valuation, earnings and multiples.
One piece of feedback I've had across the Bloomberg today, and I've seen this from multiple people, how reliable is this bond market right now? We're really struggling, it seems, to price the risk-free rate. And if I can't price the risk-free asset, how on earth am I meant to price the risk asset? How reliable is all this?
Well, the more volatile the 10-year Treasury is, the more reliable it is. That's what I would say.
Why is that?
Well, because yields are not meant to be static. The period that we had, not just the last decade, but the decade before, was unusually stable yields. Even in the early 2000s, you saw yields more or less muted versus what they were in the 70s, 80s, and 90s. That's not normal. When you get back to a more volatile 10-year part of the curve, where in any given year you can lose 5% or make 10%, that's when the financial markets become, for lack of a better term, vetted. They become properly priced. And that's because 10-year yields themselves start to build in a risk premium for duration. That's what we're starting to see. It just so happens that a lot of folks don't like that, and they haven't seen that in a long time.
Hold on a second. Perhaps this means that it's more reliable from a market pricing perspective. This doesn't mean it's reliable if you want to go long Apple, right? It doesn't mean that it's reliable if you want to price risk assets. It's a distinction, right?
Yes.
And so can you draw the distinction of how much of a pricing it means for the global financial system to see a range that is true price discovery for the first time in decades?
Yeah. So the way to think about it is it makes it much much harder to be a leveraged investor, particularly if you're going to use leveraged positions in treasuries as your quote-unquote glue. So if I'm a risk parity strategy investor, if I'm a volatility chasing strategy investor, and I use a lot of leverage, this makes it very hard to deploy those strategies. So it makes those strategies less reliable.
You're a legend at Fannie Mae. What does a 6.85% 30-year mortgage do to the American housing market?
Completely grinds to a halt. There's no refis, even cash out refis are dropping.
Price drop, how much roughly? It's an unfair question, but go with it.
On a regional basis. I mean, let's look at the early 1990s as an example. That's probably our best example with the Iraq invasion of Kuwait. I grew up in New England. We had home prices off 50%.
The Red Sox sucked that time. I get it.
They did. 1990, I think we got swept by the A's or
yes,
so.
We did.
So it's a regional phenomenon. You're looking at a similar pattern, particularly with high energy costs in the Northeast. In the Northeast, there could be parts of New York, New England, New Jersey, they could be down 20, 25% in the next 12 months.
Right.
But on a whole, the national economy, you're probably looking at home prices flat, or maybe even up low single digits.
Asking for a friend from England who's looking at the 60s and 70s Upper East Side. What's it look like there?
I think New York City is going to see a bit of a strain here because you're not just talking about high mortgage rates, you're also talking about essentially the flight from the city, the work from home, or the lack of work to come back to the office. So all of those things are going to affect the city economy, perhaps more so than you typically would see in a downturn.
You'd give away my home address if you had it, wouldn't you? You really would. Tom, thank you. It's good to hear from you. I live on the Upper East Side.
Absolutely brilliant. Folks, what you just saw there was a mathematical clinic. I can't say enough about it.
What do you have to say on the bond market? I guess a feature of normalizing, going back to something that a lot of people haven't lived for a long, long time because of the distortions and intervention we had from central banks for the last decade or so.
John, my quote of the third quarter, the great Nassim Taleb, the risk-free rate run away, and all of a sudden the gravity's back in physics.
The gravity's returned. The central bank's getting out of the way, Lisa.
So if you talk about a more reliable bond market, suddenly it changes the notion of it. If you're talking about that actually you'll have a two-way bid market, right? But what this means is suddenly it gets more exciting to go into the bond market in a way that perhaps takes attention away from the other markets. This is a new regime.
Isn't that a good thing?
For who?
I think it's a great thing.
It's a great thing if you're a bond investor. It's a pretty negative thing if you've been long big tech stocks for the past, 3 years.
Well, this is when the passive versus active debate, I think, really comes
exactly.
to life.
I think that that's a really good statement because those are the dominant names in a lot of these indexes.
Sitting in the index, market cap weight, could get difficult if we hang out at these levels of Fed funds and beyond. Yields lower this morning. We're down 6 basis points on a 10-year, 358. Equity futures marching higher on the S&P by 1.6%. Yields down 6 basis points. Equities up. Dollar weaker. Euro dollar 98.90. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The oil market is looking to OPEC Plus to deliver a substantial cut in supply. At its meeting on Wednesday, the price of West Texas Intermediate was around $84 a barrel after rising more than 5% on Monday. Currently, many nations in the cartel can't meet their current production quotas, so any agreement on a headline reduction in output would not lead to a drop in actual barrels. New York Fed President John Williams says the central bank still has a ways to go when it comes to raising interest rates. Speaking in Phoenix, Williams said interest rates are not at the level that would restrict economic growth. He said he expects real GDP to be close to flat this year and grow modestly in 2023. In Florida, the death toll from Hurricane Ian has now risen to at least 68 people. And according to modeler Verisk, insured losses are now estimated to be as much as $57 billion. President Biden heads to Florida Wednesday for a first-hand look. Samsung Electronics has announced an aggressive 5-year plan to lure U.S. chip buyers with more advanced technology. The company's chip contract manufacturing unit is looking to triple its revenue by 2027. Samsung is the world's largest chip maker by revenue, but it's playing catch-up with Taiwan Semiconductor when it comes to manufacturing. ARK Investment Management's Kathy Wood bought Tesla shares as they plunged the most in 4 months. Funds backed by Wood's firm bought more than 132,000 shares of Tesla on Monday. The stock was down more than 8%. This is Wood's second purchase in Tesla in 2022 after a year of selling down her stake. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg. From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays, this is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. And the place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
The determinant of what happens to cable over the rest of this year is more than anything else going to be what happens to the dollar broadly, but what happens to euro dollar. If it's a cold winter, the euro and the pound are both going to suffer from concerns about blackouts. If we escalate the war in Ukraine, that makes things worse. If that quietens down, it gets a little bit better. But those are the drivers of sterling.
Kit Jukes of SocGen. A little bit earlier on, we're looking at a weaker dollar this morning, that's for sure. Yields lower, equities up. Let's look at this rally on the S&P 500, up another 1.6%. Equities up by 60 points on the S&P 500. In the bond market, yields lower by 5 basis points to 358.54. Dollar is weaker, euro stronger, 98.88. Take a look at sterling. The pound stronger for a 6th straight session. And I can tell you from the lows of last week, 103.50, to the highs of this morning, which were 114.29, that is a 10% move in a week off the lows of last week. Massive move, Tom.
It's a massive move, and the big figures is like a 1 stick, and it depends where the decimal is, but a 10 big figure move is important. Of course, that wraps around to the politics, which Lizzie Burden is covering. Jordan Rochester would probably get on me. Birmingham?
I
did okay.
Hey, Jordan's a hometown boy from Birmingham, yeah.
Jordan Rochester joins us now from Birmingham right now, G10 FX strategy at Nomura. Jordan, I want to go to the news of the day, which is the Bank of Australia blinked. There's no question about that. Maybe it's a new trend, maybe it's not. If the banks start blinking like they did in Canberra, is that?
Canberra.
And Canberra, what does that mean for foreign exchange? What does that mean for your call on the dollar?
I think that's everything, Tom. Are we going to have more central banks blink? When it comes to the RBA, it stands out as one of the central banks with a mortgage market where most mortgages are variable, they're floating, so they do react to what's happening in rates markets today, in those housing markets for everybody, not just the marginal house purchaser. Where in the US with 10-year, 30-year fixes, in the UK with 2 and 5, in Europe with 10-year fixes, the impact of these rate hikes comes through with a different lag. In the UK, it's faster. In the US, it's much slower. And of course, the marginal buyer sets the price. So even in the US, your last guest was talking about the slowdown in house prices. But I think when it comes to the Fed, when it comes to other central banks, they're still going to be looking at inflation nowhere near their targets. But what's going on right now in markets is people are asking the question, oh, are we going to listen to what the Bank of England experienced last week? Will the Fed, will the ECB think twice about what they're doing, just in case we have a financial contagion risk that's building up with rates moving as quickly as they are? So I think right now it's all about mood music rather than actual action from anyone like the Fed or the ECB. I think central banks will still be hawkish. Inflation will still be stronger than they want. But right now we're in that sort of quiet space where we're all thinking, is the UK and is the RBA, are they both canary in the coal mine sort of situation?
Jordan, I sense you're skeptical. So are you fading this move? Is that what you're recommending to clients?
I mean, you mentioned a 10% move, and rule 101, and I kind of broke that, is don't chase flash crashes. And basically that's what we had in sterling after the mini budget. Huge moves, 5% moves lower. Typically, when you have that, everybody gets very convinced it's the right trade, becomes very consensus, and then policymakers react, and then you have mean reversion on that reaction, and that's what's happened. But in the UK's case, the reaction's been really timid. So just reducing the top rate tax from the 45 pence tax costs nothing, really. It's £2 billion. We're talking 100 billion for the energy package overall over its lifetime. So this 2 billion is a rounding error for the for fiscal sustainability. So for me, this is all about mood music. The UK is showing that perhaps they're not going to be as zealous when it comes to fiscal policy making. But if you take the facts as they are, everything's the same apart from that £2 billion of spending. So I am skeptical, John. And I also think core inflation in the US will remain stickier than what all of our leading indicators for headline inflation signals. Because commodity prices are softer, everyone says peak inflation. I agree with that. But core inflation will be stronger than you think. Because look at job openings in the US. They're just ridiculously high, and they're not falling enough to say that we're having a weaker labor market. So this all feeds into the Fed not being happy where things are. And this softness in US yields, I don't think it will last.
So, Jordan, we were talking to Tom Sisouris of Strategas, a Baird company, earlier, and he was talking about how the price action that you've seen in 10-year treasuries and 2-year treasuries indicates stability, indicates price discovery in a way that we have not seen in years. Is the same true for your FX market, with the pound rallying 10% off of an incredible swoon?
I think most of that is poor liquidity, positioning in sterling being very one way. And then we had the rebalancing of month end. And we've got to remember as well, this pension situation meant that the amount of flows going through in the UK were huge. So it's kind of hard to say that, is this a fundamental price discovery that's going on? Or is this just everybody being one way and pensions being bailed out by the Bank of England's QE program, which comes to an end in less than 2 weeks? So we have to watch out for that cliff edge. What happens to the UK rates market once that QE program comes to an end? I think price discovery is still in effect. The US has everything the world needs. It has oil, it has LNG exports. The Europeans don't have either of those things. And a key difference, when they imported that natural gas from Russia, it was priced in euros. Not anymore. It's in LNG, it's in dollars. So there's a fundamental terms of trade shift that points to euro being at 90 cents by the end of this year.
Jordan, let me make clear, and I'm not trying to sell Nomura on this, but when the LDI scandal was breaking, I used a Nomura research report from 2018. Jordan, it was scary accurate about what the mess would be in the British pension market. Jordan, where's the trade opportunity right now? I mean, where's the big figure opportunity right now, everything considered?
I think where we are today, I think we've got this dollar softness thanks to lower US yields. It's backed up by mood music, the ISM being weaker, potential for China having this marathon and masks being taken off for that marathon. All kind of mood music stuff, not fundamental game changers. We've got NFP coming up on Friday. I suspect we'll have a strong average hourly earnings number. I think the jobs data will still hold up the growth on that side. So I think folks will be surprised, again, by US jobs not slowing down as they expect from all the growth signals we have. And then we've got the CPI the week after. So I think really the trade is to fade this dollar weakness. It looks like everything we saw in May looks at what we saw in August. We had these kind of big drawdowns in the long dollar trade, but the trend is still there. So euro to 90, cable to parity and below.
Jordan, can you just congratulate Tom for saying Birmingham and not Birmingham?
I'm working.
We've been working on this, Jordan.
Working on it.
Next is the Brummie accent, so if he can say,
Yeah.
"Good right, mate,"
There
you'll
we
be,
go.
you'll
Can
be,
you do
you'll
that,
be.
I want to go up to the
got
Plough and Harborne and have a true full English.
That
The
was-
full English up there is different.
That was
than
an
down in
authentic
London.
Brummie accent you
It
got
was.
just
It's
then.
very authentic.
From Jordan Rochester of Memora.
It's a real
Jordan, thank you. We're in trouble with the Aussies.
Tom's wrong. Let's cut
clean
to the
this up?
chase.
Can we tidy this up a little bit? I'm not sure how we even got to this.
Me?
Canberra is the capital of Australia, right? But the RBA is in Sydney. Okay? We've
Yeah.
done that now.
Yeah, we've done this. I mean, this started out with Bloomberg on the economy decades ago. The thing is so fast what we're doing that we make errors constantly. Lisa's never made an error.
Never does.
But, you know, you make errors and you correct them. That's
the
all.
Brits are writing in, is Birmingham like Maryland?
No, I like that. No, don't correct that ever. No.
It's different.
By the way,
That's
I'm going to
okay.
go home.
Maryland.
I'm going to go home and tell my kids I never make mistakes.
I feel like
and I
it's-
pronounce everything perfectly.
You don't. I
When
can
John
vouch for
says
that.
Maryland, when John says Maryland, it feels like Downton Abbey. That's all there is
Maryland.
to it.
Maryland.
It's a very merry land.
Maryland.
Isn't it an improvement? That's
The
better.
Orioles had a great year. It's a Maryland.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, you know, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
Today's CFOs are reshaping the C-suite, breaking out of traditional roles to become Chief Future Officer. Global logistics is complex. It takes plenty of capital and plenty of focus. Deutsche Post DHL Group CFO Melanie Kreis makes sure her company has both.
My role is essentially saying what is working well in this company, where do we have challenges, and what should we do going forward.
Chief Future Officer, Wednesday on Bloomberg. Brought to you by Workday.
Connection lost.
Bloomberg's covering all things crypto, the people, the transactions, and the technology. Bloomberg Crypto, today on Bloomberg. The market markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today. It's going to be short term.
Bloomberg Markets, The Close. Weekdays on Bloomberg.
Inflation is still stubbornly high.
Once inflation comes down, not only in the U.S., but also abroad, where you're going to see basically a bit of a relief rally.
I think the economy actually shows resilience here.
Getting those earnings expectations down is something that we really need to see.
I see earnings going sideways. I think we're already in a recession. It's just a growth recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. We are together in New York on radio and television. Thank you for joining. With a lift to the market, John, do we look to Sydney, Australia for a lift? Futures up 62.
You're calling it a blink. They go 25 basis points. The
Instead of
market
50.
was looking for 50. I get it. That plays into the broader story this morning of peak yields, peak dollar, peak Fed, peak volatility. Take your pick, Tom. We're doing that again.
And we're on there in an important conversation in this hour. We'll talk to Citigroup about their linkage of the jobs report Friday into what this Fed does forward.
Bad news is good news, Bramo. That's what we're hearing from Citi this morning.
Yes.
Basically, what they're saying is bad news this Friday could be seen as good news for this market.
And how much is what we saw yesterday with the ISM data that came in a bit softer, actually giving some wind to what we're seeing in the markets, which is a reversal, this idea that perhaps we have enough ammunition to talk about some sort of weakening. And do you have accelerated moves? And Tom, I wonder if this is the case, if you're seeing basically outstrip moves because of a lack of liquidity and positioning where people are just basically taking a pause.
Well, we're not taking a pause. In the last 2 days, it's been sobering. But what you mentioned, John, earlier, the Ray Dalio capitulation, cash, not trash. I get it. Okay, great. But is this a true capitulation? I don't see that.
I don't think it is just yet, but we have seen a repricing, and the repricing is important. We've taken the peak Fed funds rate down from about 470 back down to about 440. I think 30 basis points is significant, and that's feeding into the overall enthusiasm in equities. I'd go back to something Mohamed Al-Arian said, though. If you're pivoting, pausing at the Fed for reasons like financial instability or recession risk, or the fact that we're in a recession right now, is that bullish? And I think that's a question we've got to discuss.
Lisa, quickly here, Tom Satoris of Strategas, I thought, was brilliant on high yield. What's high yield dynamic signaling? He's pretty grim on the spread market of troubled debt.
There is this question about whether we see a default cycle like what we have before. And we were talking earlier, John, you brought this up. Have we readjusted to the idea of, let's say, 10-year yields remain around this 4% level for a longer percent? Well, you get 10% when you look at high yield bonds. I mean, that's where you end up.
Sure.
And how much have we really priced in the potential weakness, what that does to rearrange the rest of markets that have been financed on 0% rates? This is the unknown.
I'm going to go back to support here. Let's get to the data, John, because we've got Jeff Yu coming up, important a guest. I'm going to look at the real yield, 1.37%, sitting on support, going nicely back to the third week of September.
I'm looking at stocks up and away on the equity market, on the S&P 500 up by 1.7%, up 63 points. We've talked about equities up, yields lower, down 5 basis points on a 10-year, 358.74 this morning. Last week through 4%, and that's the turnaround in this bond market. We saw 4 on 10s, we now see 360. You saw 435 on 2s, and you now see something closer to 4%. And off the back of that, you've got a weaker dollar. Euro dollar 98.91, that currency pair, Tom, firmer by 6 or 7 tenths of 1%.
The real value here, folks, is what we say in commercial break. I wish all of you could feed into the conversation with our guests as we prepare for the hour. Jeffrey Yu joins right now, senior strategist, BNY Mellon. Jeff, I'm learning every step of the way, and I want to talk about the dynamics of every nation and every political leader as they try to amend policy for the elite. Now, I've learned that the elite are the prawn sandwich brigade. And there's no question about that, going back to Truss in the United Kingdom. Are we making policy now for the elite that will crush the middle class?
but you are allowing Manchester United fans to reminisce about the old days. Really, at least they were winning when the prawn sandwich brigade was coming through. But that is the perception right now, and we have to just acknowledge that politicians, when you're setting policy, you have to be extremely cautious about the distributional effects of this. Even before the Chancellor launched his supposedly mini budget, we were concerned about the distributional aspects of the energy support plan. Why are you subsidising high-income households to the same level as lower-income households? And now it's coming out into play, and this will really generate a lot more volatility in policy making and translate into market issues further down the line.
Jeff, from your position, are financial stability concerns bigger than inflation concerns for these policymakers?
Sitting from London, no. I think this time around, in respect to the pension issue with the LDI issue, you've seen the purchase volumes at the end of the day. It was basically a precautionary step, warnings being sounded, and basically the Bank of England said, we will be on the other side of this. As I mentioned last week, right, it's whatever it takes when it comes to financial stability, and I think markets get that. But at this point, it really is back to inflation. Inflation's the number one priority. Until inflation is under control, monetary policy will still have to chase inflation, trying to cap it, and that's where financial conditions are tight, and you can get accidents as well. So there can be no rest for financial stability until we tame the inflation side of things as well. The two are intertwined.
Jeff, do you think that we've overplayed financial stability concerns based on what happened in the UK and based on the fear of how much liquidity is being withdrawn from the system?
Right. I don't think we've overplayed it per se, and there are individual structural issues behind the LDI framework within the UK, but to automatically assume that what happened in the UK is going to cause the Treasury market to crack or fissures elsewhere, I think that side of it was a bit overdone, especially the interpretation that the next phase is, oh my God, central bankers, they've overdone it, it's going to be financial stability issues everywhere, they're going to abandon inflation targeting. That side of it clearly has been overplayed.
But is there some truth to this idea that perhaps central bankers are rethinking the pace in which they want to raise rates, that perhaps it's not necessarily the target that's changing, but how long they are willing to execute these rate hikes over, and that the RBA is a good example of that, that they're actually going much slower, but they're not necessarily pulling back wholesale from a tightening cycle?
So it really depends on which specific side of the economy in a financial stability context that you want to manage. Take Australia, for example. I think it's a terrible example for the rest of the market, because their cycle is not exactly linked to where the US is. It's much more linked to China and the like. And also Australia, they've been highlighting their own domestic household leverage, one of the highest within the G10. So that side of things would decelerate far quicker. And crucially, I think markets are missing this. The RBA have clearly cited beforehand they wanted to front load things as aggressively as possible. So it shouldn't become too much of a surprise that they will hit peak yields, they will hit terminal sooner than the rest of the market as well. Basically, just want to say to the market, don't extrapolate too much from what the RBA did overnight.
So, Jeff, let's set up the Federal Reserve in the next month or so. Another 75?
That absolutely has to be the market-based case until they really start to see proper fissures within the Treasury market or elsewhere, even anything remotely close to the gilt market. What happens to the gilt market? We are not seeing that at this point. But of course, they probably will need to acknowledge that financial stability is something that they are monitoring. But let's put it this way: we are not where we were in 2007, 2008. Europe is not where it was in 2011, 2012. There are so many tools at their disposal. They can handle this, and they will be on the other side of financial stability. And based on reaction in the gilt market so far, I think markets believe them.
Jeff, where does that leave QT? How sustainable is that effort?
So QT is sustainable as well, especially in the US, where they have a better handle on the inflation versus financial stability argument. In the UK, we saw the initial fissures, but the BOE have been clear to stress that they're slowing QT to preserve financial stability, to monitor it. Once they know where the risks are, they've covered their bases, then they're already, I think they will be able to resume the QT framework as well, because that is a monetary policy operation. They want to separate that from financial stability risk. But if there's the first sign that the monetary policy operation will begin to impact financial stability, there can be a new argument, there can be a new discussion over that. But until there's decisive proof of it, I think they're going to continue with QT as well, because that's necessary to slow inflation.
That's the US story. What about in Europe? Could you see perhaps a reversal not only of QT, but an engagement of effectively quantitative easing, as Freya Beamish was saying earlier on this show?
Right. So I think for Europe, again, idiosyncratic risks do matter, but they have OMT, they have the TPI as well to manage any spread widening, the fragmentation risk. So they have that side of it covered as well. It hasn't really been an issue over the past few weeks or so. It's there. I don't think markets want to test it. QT will take place in Europe when the market is ready for that, but I just don't think they're strong as consensus within the governing council right now on rate hikes, let alone QT. So that's where Europe is probably one step behind the rest of G10, and I think that's been reflected in euro-dollar as well. But with the latest inflation print, I think they need to accelerate.
Hey, Jeff, I've now got to explain what the prawn sandwich brigade is, so thank you very much for participating. Jeff Hughes,
nailed that.
BNY Mellon. Jeff understands this. He remembers as a Manchester United fan. Back in the days of Alex Ferguson, Sir Alex Ferguson, phenomenal, legendary manager of Manchester United Football Club, the atmosphere at Old Trafford, the stadium, was dreadful. And he would refer to those fans as the prawn sandwich brigade. The wealthier crew that turned up, unpacked their prawn sandwiches, nibbled away and didn't make too much noise. He wanted more noise, Tom.
Yeah.
More support in the stadium, a bigger atmosphere, and he didn't
We
get
have the
one.
same thing here. I mean, I'm hugely critical of the New York Yankees, and you see when they play, fabulous team, all the empty seats from the prawn sandwich
You
brigade
price out the real fans.
down the restaurant, and they're gone. I give Fenway very great credit for this, and down Fancy, you sit in the same chair essentially.
You know
as
what
up
drives
top.
me insane? Empty corporate seats.
Yes.
Drives me nuts.
Yeah.
See that at the US Open courtside.
Yeah.
It'd all be empty around the boxes. People got free tickets and didn't show up.
I was looking down at that at the Open there when I went the other day.
I saw your seats.
So hold on a second. Prawn sandwich. What's the other side? What's the traditional? Is it
you
pie?
have a pie.
A
You have
pie.
a pie.
But no, but if
Pie.
you're a
Yeah,
tourist,
pie and a pie.
this is
Yeah,
important,
okay. Sorry,
folks.
you get a pint and a pie.
On radio, I'll try to do this. If you're a tourist like me, I don't know
Yeah,
what
this
you're
pie
supposed to
with a
do.
knife and
I'm
fork.
eating it with a fork.
Even I knew that was not right.
And John Farrow's on the
saying
phone. He's
something.
seeing me on the camera. He's like, what
Honestly,
the hell are you doing?
I wish I'd got a
It
picture
was
of
just
this.
so embarrassing.
On your
Pie
lap
with
like
a knife
this.
and fork.
You just show us that you grab it and you
Yeah, just eat away.
Eat away.
We've started the Maryland thing as well.
Yeah.
Thank you to the Bloomberg subscriber who helped me with that. Maryland.
No,
And
say Maryland.
Thank you to someone else
John,
who said,
you lose your innocence.
I understand the state is so taken with John's pronunciation that December 1st they will officially change their name to Maryland
There you
for the
go.
holidays.
Good.
Maryland. That is wonderful.
I'll
Okay.
change that.
From New York. We upsetting anyone else this morning? A whole country?
Oh,
a state?
I have a couple.
What's left? You got a few more to go?
Sure.
Okay. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In the UK, Prime Minister Liz Truss says she hasn't decided yet whether welfare payments should be increased in line with inflation. And that's an issue that threatens to cause another fight with her disgruntled Conservative members of Parliament. In a radio interview, Truss said that pensioners would see their payment rise along with inflation, but she wouldn't commit to the same for other welfare recipients. In Ukraine, President Volodymyr Zelensky said that liberating settlements from Russian occupation is now the trend. His forces have pressed further into the eastern Donetsk region and seek gains in the south. Meanwhile, the Biden administration will announce another package of U.S. weapons within days. Tensions are increasing over Kim Jong-un's nuclear weapons program. For the first time in 5 years, North Korea filed a missile that flew over Japan. And that prompted a rare public safety warning from Tokyo. The missile splashed down in the western Pacific, about 2,000 miles east of Japan. And if you're looking to get away for the holidays, book your travel flights now. The Wall Street Journal says already high prices will rise in the coming weeks. A recent search from travel site Kayak shows the average price for domestic travel during Thanksgiving week this year up 48% from the same time last year. And during Christmas, well, it's even worse, up 52%. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
What do Formula One cars and your local supermarket have in common? Well, strange as it sounds, they might both be using the same technology. A lot of innovation has trickled down from the world of high-tech engines, and it hasn't just found a new life in road cars. F1 cars have long been thought of as the peak of cool, and technology in them is also helping to cool down our produce aisles. Engineers from Williams are using their knowledge from 9 Constructors' Championships, working with company Aerofoil to help reduce the energy consumption of supermarkets. The device they're building is based on the design of an F1 car's rear wing. It attaches to fridges to keep more cool air in the unit. They estimate it can reduce supermarket energy consumption by 25%. One innovation from F1 is also helping hybrids reduce their carbon footprint. That's KERS, or the Kinetic Energy Recovery System. In common parlance, it's known as regenerative braking and works by storing energy of the car decelerating in a battery for later use. If that's not enough, F1 is now looking at TERS, or a thermal energy recovery system, looking to harness the heat produced from braking and the engine exhaust. That could allow cars to generate the same power using 30% less fuel. So while F1 may have a reputation as a gas guzzler, some of its innovations in the name of speed are helping in the everyday fight against climate change.
I'm Kaylee Lines.
And I'm Damian Sassower. Join us each week on our brand new show, The Lineup. If you're betting on the Mets, it's a pretty good return.
We'll cover the latest trends in sports betting, the hottest matchups, shifting spreads, and the data you can't find anywhere else. It is crazy how much the money line has changed from the preseason to now.
Plus, expert insights from special guests.
The Eagles got a gem on their hands. I hate to say it because they're in the NFC East with the Giants.
Odds are it'll be your favorite way to stay in the game.
Catch The Lineup Fridays and Saturdays only on Bloomberg.
Difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
There is a lot of monetary contraction and austerity coming down the pipe.
The September Jobs Report, Friday on Bloomberg Television and Radio.
Evidently, the decision will come tomorrow. That should be, I think, a 1 million barrel a day cut. We've got about half of that probably Tom actually delivered. But it's still enough to tighten what's effectively a market imbalance in Q4. So any cut will effectively serve to raise prices.
That argument is what's behind the rally in the crude market in the last 24 hours. That was Paul Sankey, the founder and lead analyst of Sankey Research. Crude right now on Brent at 1.5% to $90.20. On WTI up 1.2% to $84.65. That's the commodity market. Here's the story more broadly in the equity market and beyond. Equities up and away, up 1.7% on the S&P with yields lower. Treasuries firmer, 358.54 on a 10-year, down from 4% last week and down 5 basis points on a session. Talked about this a lot this morning, Tom. Dollar weakness, euro strength, 98.96, euro dollar, positive 0.7%.
Watching real yield, 1.36%. If that cracks, that's important to me. We have not seen that yet. Right now is a joy. Pavel Molchanov is at Raymond James out of Duke Economics, and far more, he is someone who's put money where mouth is in great work in energy and sustainability for Raymond Jeffries, and also his work on charity. I would point out the Molchanov Sustainability Internship Program at the Royal Institute of International Affairs in London is something Pavel works on. Pavel, thank you so much for joining. I've got to turn to OPEC, which is maybe not sustainability, but there it is, OPEC Plus. You are heated. Watch what they do, not what they say. What is the distinction?
Easy for OPEC to announce a production cut. We've seen that, countless times for decades. The real test is implementation. So we know that Saudi Arabia tends to be disciplined, tends to fulfill their commitments. But many OPEC members, you can think about Venezuela, Angola, Nigeria, they do not tend to implement what they promise. The logic being, they need the money, lower income levels. So the burden of actual enforcement tends to fall on those core Persian Gulf members, particularly Saudi. Will they single-handedly carry this potentially million-barrel-a-day production cut? We'll see. It happened during the first days of the COVID crisis, spring of 2020. Saudi Arabia was amazingly disciplined at that point. But of course, now these are very different times.
Pavel, how much is demand actually declining versus the expectation that it will decline in the face of slower growth?
Well, to be clear, global oil demand is tracking to a significant up year, between 1% and 2% growth in 2022. Of course, there is still some post-COVID catch-up in that. The real question now is what will demand be next year? We think it will be up, perhaps not as much as, we would have said 6 months ago before all of the monetary tightening around the world, but it should be up. I will just remind, as by way of historical background, only 4 times in the past half century has global oil demand declined. So 2020, COVID. Before that, we have to go all the way back to the global financial crisis, and before that, to the early 1980s. So it's highly unusual for oil demand to shrink on a calendar year basis.
Given that, how much do oil prices stand to increase? If OPEC Plus does approve a million-barrel production cut, and you do see demand increasing, not decreasing next year, what is the effective resulting price of the barrel of oil?
A million barrels a day is 1% of global supply. We know from what's called elasticity in Econ 101 that on average, a 1% reduction in supply creates a 5% increase in prices, all else being equal. So we're talking about $5 a barrel extra. But let's remember, we have some other variables we need to think about in relation to the oil market, including, of course, the war and everything flowing out of that. Russian supply has already declined and will continue to decline.
Pavel, I want to go to your wheelhouse of sustainability. Is ESG forever altered by the war, by the moonshot and coal that we see, like in Australia? Newcastle coal really hasn't given it up. How does ESG adjust to the next decade?
The war has not changed the basic paradigm that ESG will be a source of pressure on fossil fuels, both in a fundamental sense and in an investing sense. So, for example, let's zoom in on Europe, which is in the middle of an energy crisis. Yes, there is a little bit of an uptick, maybe 2%, within the electricity mix of Europe in terms of coal consumption. But we're still talking about barely 11, 12% of Europe's electricity coming from coal this year. By 2030, that number will probably be mid-single digits. So the trajectory is heading in one direction. And coal is the biggest, sort of public enemy number one in a climate sense. And this is where a lot of divestments of major institutional investors are focused on. Not as much attention on oil and gas, but certainly those sectors are also out of favor from an decarbonization perspective.
Pavel, wonderful to get your thoughts this morning. Thank you. Just getting some headlines out of Europe. Pavel Molchanov there of Raymond James. Allow me to turn to those headlines. Olaf Scholz, the Chancellor of Germany, with a meeting with the Dutch Premier, Mr. Rutte, who we've spoken to over the years. Tom, good friend of this show. Scholz says Germany seeks a considerable reduction in energy prices. Now, I assume Lita is talking about this winter. Beyond this winter is the conversation we've tried to have over the last several months.
And what it takes to get those considerably lower prices, is it that 200 billion euro package that's causing quite a bit of consternation among European allies? And what does that mean for the rest of the bloc that can't afford that kind of support for their energy companies and their energy bills for the households?
So this is the issue that Maria was getting at a little bit earlier this morning. Was she in Luxembourg? From Luxembourg, I believe. I can't keep up with Maria today.
Her hair wasn't blowing as much as usual.
That means she's indoors.
Yeah, exactly.
You said that, not me. Tom, this is the issue. I know. I know.
Oh my word.
Let's move on. This is the issue in Europe right now, that package from Germany was so large. Who else can follow with anything like that in southern Europe?
Oh, that's the dominance of Germany. That was in one of the research notes this morning. Carl Weinberg, I think, had that, where Germany is just completely dominant. What I would note is what you mentioned a couple days ago. There's a difference between 9% in 10 or the Netherlands 11% inflation. Double-digit changes the dialogue.
The minister from UAE right now, OPEC Plus to take decision after reviewing the market outlook. We're all assuming that takes longer than 13 minutes this time around. From New York.
Get to the A block.
This is Bloomberg.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding, and the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect. How do Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
bit of data out later in the United States for America. Factory orders, durable goods, capital goods, jolts, job openings, all coming out in about an hour and 30 minutes time. Going into that, equity futures elevated, pushing higher, adding some more weight to the benchmarks here in the United States. Futures up by 1.6% on the S&P, building on the gains of yesterday, the biggest one-day gain on the S&P, biggest one-day pop since July. Yields lower yesterday, aggressively so, by around about 18 basis points on a 10-year. Down another 3 this morning, Lisa, 360.52 on a 10-year.
So here's the issue. Is this just basically readjusting with pensions and other investors seeing some value here in duration heading into a downturn? Or is this something that is a head fake, right? Is this basically people covering their shorts, reassessing before the next leg of whatever Fed communication we're
Governor Lowe's the lead indicator for global central banks, didn't you know?
Is it so?
And the RBA.
Yeah, the RBA.
Going 25 instead of 50. Everybody getting on board with that because it speaks to the price action we've seen in the last day or so. Yields are so much lower, Tom, now compared to where they were a week ago.
A week ago.
On a 2-year 435 and now at 4.
And again, as you mentioned, the shift is what's important here. We've seen a shift in yields, not the dynamics of the yield curve so much. 10-year real yield 1.38%. What I would note, John, is this is where the pros focus on the fixed income market versus the other markets to get signals.
I want to turn to the work of Citigroup earlier this morning.
Please.
Andrew Hollenhorst, Veronica Clark on the team. This is what they had to say. We continue to see fundamental economic risks as balanced toward higher rates and lower risk asset prices. This was just for you, TK. I asked Andrew to put it in there. Friday jobs report is growing in importance. A softer reading would continue the, quote, bad news is good news for equities narrative. That's the story of the moment.
There it is from Citigroup and their update. We're going to see a lot of that migrating to Wednesday, Thursday. I got my prawn sandwich over here. I'm going to have my Tang. Leave me alone. Veronica Clark joins us right now, global markets economist at Citigroup, and we are fair and balanced. As we just had a gentleman from Duke on, that's a small school, 8 miles from UNC. We speak to Chapel Hill's Veronica Clark this morning. Veronica, okay, so we get a good jobs report, well over 200,000, maybe 300,000 jobs. We are so far distant from a non-farm payrolls, which is what the Fed desires. Do we get there abruptly?
Yeah. I don't think we get there just yet, but we will be watching for signs, later this year and into next year that you could start to see that, more consistent slowing in monthly job figures. We're expecting a 265K on Friday, which is still very strong, but slowing. But as we're getting into mid next year, I think that's really when we see the negative prints that could start to pop up, and that's really the loosening that the Fed wants to see.
Are wage dynamics in the wage part of the Friday jobs report signaling wage inflation?
Yeah, we're a bit higher than consensus on average hourly earnings, so we're expecting a 0.4% month-on-month increase. Also expecting the unemployment rate to fall to 3.6%. Both of those together are really what the Fed doesn't want to see, and that is still a really tight labor market. I think really what the Fed is looking for in all the wage data, all the jobs data, all the inflation data is signs of a loosening labor market, and I don't think we get that quite yet.
Veronica, we were speaking with Tom Porcellia in the past week or so, and we were speaking about this on the show earlier. He was saying that there's been a structural change in the labor market and that we may not see the weakening in the jobs, in the labor picture, just because that people have had such a hard time hiring enough workers during the pandemic and afterwards. Do you think there's credence to this?
Yeah, absolutely. I think if you look at the number of people who left the labor force during the pandemic, and then you look at the overshoot of job openings, that are around 11 million versus 7 million before the pandemic, that's about the 4 million people who left, and it doesn't seem like that demand is going away. So the fact that job openings are still so high, and we'll get that data actually later this morning, it could just take a while, to see this slowing in hiring.
So then how should it be looked at in terms of understanding the weakening and the pace of the weakening in the economy? I mean, are you sympathetic to the view that perhaps the Fed is looking at a backward-looking indicator, as John has mentioned, in order to make forward-looking moves at a time when the economy is moving faster than we've seen it move in decades?
Yeah, that's very fair. These monthly job figures that we get are some of the last usually to turn. They are more lagging indicators. But I think if you look at all the labor market data, as a whole, something like initial jobless claims, which are still very low, those tend to be a more leading indicator, and it's still also pointing towards a really tight, strong labor market.
What is the undershoot, the blink by the Reserve Bank of Australia? What does that signal to Citigroup?
Yeah, I mean, I'm not an Australian economist, of course, at all. But I think markets in general are looking for this sign that maybe central banks are, reaching the highest level of rates that they can get. Maybe we're at peak pricing. But for the Fed, at least, I would really caution that, we've been here before. We've been looking for this peak before, and it really hasn't happened. The Fed is just going to stay focused on domestic data, labor market data, inflation, and we really haven't seen any change there.
Away from labor market data, what data matters to determine a Powell peak?
I mean, definitely inflation. Inflation, of course, is still the most important. And really, since the September meeting, we've had really just one data point for that. That was PCE inflation last week. And if anything, it looks like the Fed's forecast in September for 4.5% PCE, core PCE at the end of this year are still too low. And of course, we'll get CPI next week. We'll be looking at the details of that. You could see weaker goods prices, but if you still see really strong services, that's telling you that underlying inflationary pressures are still really high.
Let's look out past this Friday when we get non-farm payrolls, which may be increasing in import, and beyond to earnings. And we've seen some preliminary earnings reports that highlight increasing weakness in the pace at which companies are revamping their expectations. How closely are you watching that? What are you looking for in these earnings reports to perhaps reassess how either deep the downturn is or what the Fed response could be?
Yeah, I mean, we are certainly looking at, business sentiment. Of course, earnings is part of that. Because how the Fed sees, policy impacting the real economy, I think, is through businesses seeing, earnings that are weaker, equity prices that are lower, and them saying, oh, I need to cut costs, I need to lay off people, I need to not hire as many. And that's eventually, of course, what causes the loosening in the labor market that brings inflation lower. I think could just be a longer lag between when we see that worsening sentiment and when we actually see it in the hard economic data.
This lag, people have been talking about it. Do you think the response to the lag is to go slower? This is one of the key debates among Fed officials, to move slower, but the same level as where there's targeting of 4.5% plus or minus a little bit? Or do you think that this is something that they're going to ignore? They're going to just keep going at the pace they're doing front load and then stop when they get to that 4.5 and figure out what the damage is?
Yeah, it is a bit interesting. I think that the Fed, seems to signal even more 75s. We're expecting another 75 basis point hike for November. It would make sense to me that maybe you slow down and you go consistent 50s. Maybe, you give yourself time to see that, weakening in inflation, weakening in the labor market show up. But for now, it seems that they're on this front-loading path, and we do think rates can get to 4.5 to 4.75 and stay there. But the risk would maybe still be that they go even higher.
Veronica, unfair question. When is good news just good news?
Maybe at the end of 2023 when we're hopefully coming out of a recession.
Dear me, you've got to wait that long, TK. For good news to be good news, end of 23.
While you were doing this, I was looking at the WIRP function. We're just all wrapped, the prisoner's dilemma, 4 boxes, good news,
Sure.
Good news, bad news, whatever. Bad news. Alarian is correct. This is busted game theory. Look at the fundamentals. And I'm sorry, there's some recessive statistics out there, starting with China. To me, that's way more important than the financialization of our dialogue.
Conceptually, though, it does make sense to have that argument. And Veronica, fantastic to catch up with you as always. Veronica Clark there over at Citi on the team with Andrew Hollenhorst and company. Conceptually, it makes sense, right, that good news becomes good news once you've seen your way through this recession and you want to see the better data and the Fed's got out of the way.
When it becomes the point where the Fed is not the main driver of price action.
And it is right now.
Right, it still is, and that is the real main point here. The Fed is still driving a lot of the activity at a time when they want to pull back. They want to not be the sort of puppet master behind the scenes here, which they have been for decades.
Job openings a little bit later. Is that the key data point for you today?
Absolutely.
At 10 a.m. Why?
Absolutely, because they're looking at the labor market. They said that they're not going to take their foot off the accelerator until they see jobs really become less prevalent, until they see the loosening in that market. And you're not seeing it certainly in the initial jobless claims. So to me, that is the key data point of the day.
That's the hope, Tom, that we can get job openings to come down. without smashing the labour market up too much and causing a big recession.
I'm with selected people. Mike McKee tells
You're not alone.
Mike McKee tells me JOLTS really matters. That's the reason I'll be blunt. If McKee says it matters, it matters. But the bottom line, I don't care. The bottom line for me is simple. We're arguing about the employment of people in America. I think it's just
Tom, it's
distraction.
Absurd.
It's absurd.
No, I actually think it's worse than that. I think it's worse than that. This is going to get really difficult for this Fed, and it's something we haven't talked about for at least a week. If unemployment starts to go in the wrong direction over a long period of time, and this Fed's still hiking interest rates, then the communication of this Fed, I think, just gets harder. With Senator Warren, I imagine Senator Warren finds a lot more company going into the midterms if this labor market is cracking over the next month. I imagine she finds a lot more company.
And it will be bipartisan as the job losses start to mount, because nobody wants to see people lose their jobs. And yet, how do you achieve some normalcy to inflation? It puts the Fed between a rock and a hard place. Communication is going to be fraught.
TK?
I think there's an underestimation of the technology overlay. There's an underestimation of the entrepreneurial spirit of America. I get it. It's massive systemic uncertainty right now, but to focus on financialization of it like it's a parlor game just has no service.
Do you think companies will adapt?
I think companies will adapt with a vengeance. With a vengeance.
This Fed will be data dependent as well.
The most
will be
important,
data dependent, and companies will adapt.
The most important thing we did today was Abramowitz on the wall with the equity model of big companies adapting.
Where's that pen come from? You're pointing at the camera. Where's that come from?
He just keeps it there.
Is that your
as
new,
a pointer?
No, I've had this. It's just we're all together.
That's new. That's new.
A laser.
Come in with a stick tomorrow.
No, I'm going to get one of the laser guns.
1.5. Yeah,
the laser thing.
This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The oil market is looking to OPEC Plus to deliver a substantial cut in supply at its meeting on Wednesday. The price of West Texas Intermediate was around $84 a barrel after rising more than 5% on Monday. Currently, many nations in the cartel can't meet their current production quotas, so any agreement on a headline reduction in output would not lead to a drop in actual barrels. Bloomberg's learned that the UK sees the prospect of a deal with the EU on Northern Ireland's trade arrangement within months. People familiar with the matter tell us the government has softened its approach, and that's led to a significant shift in the dynamic over the past month. That could finally draw a line under Brexit negotiations more than 6 years after the UK voted to leave the EU. In Florida, the death toll from Hurricane Ian has now risen to at least 68 people. And according to modeler Verisk, insured losses are now estimated to be as much as $57 billion. President Biden heads to Florida Wednesday for a firsthand look. Samsung Electronics has announced an aggressive 5-year plan to lure U.S. chip buyers with more advanced technology. The company's chip contract manufacturing unit is looking to triple its revenue by 2027. Samsung is the world's largest chip maker by revenue, but it's playing catch-up with Taiwan Semiconductor when it comes to manufacturing. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Apple's delaying its next major iPad software update, iPadOS 16, by about a month from September to October. Apple made the decision for a number of reasons, including a still buggy Stage Manager multitasking interface, and in order to link the launch closer to the more similar macOS Ventura. Still, it's an unusual move. Since shifting the launches to the fall in 2011, Apple has released its new iPhone and iPad software updates simultaneously each year around September. By staggering the releases, users may find some issues around compatibility with cross-device features like retracting and editing messages in iMessage, the new shared iCloud photo library, and the new feature for transferring FaceTime calls between iPhones and iPads. It will also make it a bit harder for developers to launch apps that run on both the iPad and iPhone that require new APIs and features found across iPadOS 16 and iOS 16. Regardless, it was still, of course, the right move. Stage Manager on iPadOS 16 is still quite buggy, I don't find it particularly intuitive, and it's not compatible with most iPads and many third-party apps on the App Store. The feature clearly needs some more polish. And complaints from consumers about Stage Manager will now no longer probably overshadow the earlier launch of the iPhone 14.
If you do any kind of business in this country, there's a pretty good chance that you're going to see that business registered in Delaware. Why? Because that's where you do it. And our point was Wyoming can be that venue for blockchain enterprise, for crypto.
It's not the Wyoming way to sit around and wait for change. We want that independence, we want that freedom, we want that individuality. And that's a common theme that brings together bipartisan support for this in Wyoming.
We want to make sure that people understand, especially in Wyoming, but as the United States as a whole, this trend is coming. It's not going to stop. This is more of a small town that's growing into what I would call the cryptocurrency version of Silicon Valley.
It's the philosophy of that rugged individualism, the independence, and the ability to really get things done for yourself and control your own destiny. You get that from a blockchain, and you don't get that without it.
From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg.
I'm totally stumped, mystified, surprised that Fed officials don't seem to acknowledge that just focusing on the Fed funds rate as part of the monetary tightening cycle is a mistake when you also have QT2 and you have a soaring dollar. I think they got one more rate hike coming in November, and that'll be it because the financial stability issue will pop up as primary concern. They listened in Sydney. RBA blinks this morning. Big news about 12 hours ago, maybe off of Edward Yardeni. Dr. Yardeni there with a really controversial comment about a Fed that has, quote, one more move left. Of course, part of the parlor game. We welcome all of you on radio, on television. Lisa Bramwitz and Tom Hakeem. Mr. Farrell back in makeup for the next hour. Always good and important for him. What do you think of Dr. Yardeni's effort there?
I can say I don't think that the RBA only raised rates by 25 basis points because of what Ed Yardeni said on the show yesterday. However, I mean, I'm just, I think, though, that there is this issue of a very different market, and drawing the distinction between Australia and, say, the United States is going to be important for discerning the tea leaves for the Federal Reserve versus the RBA.
And part of that is what we see in the fixed income market. Everybody has a lesson where they learn fixed income really matters. For me, years ago, it was when Amazon blew up, and Lehman Brothers was way out front on the credit dynamics of Amazon versus all the buy-only equity certitude that was out there. What does the bond market say right now about the ballet into fourth quarter?
Well, there's a resetting right now as you are getting a real demand into, particularly the long end, into treasuries that are 10 years out, 30 years out. How much this really is any indication, though, it goes back to something that Tom Tsouras was saying. that this actually is giving him some confidence in the reliability of this market, not because you're going to see some constancy or lack of volatility, but because you're seeing real price discovery for the first time for decades.
Maybe the zombiness drifts away in the bond market. Look for Satoris' interview out on Bloomberg Digital right now, and this is a joy. Paul Davies is somebody, you know, he was at the Journal of the FT, and I was like, oh, damn, I got to read this. He's now with Bloomberg Opinion, and we are honored by that. Paul Davies joins us this morning. Paul, the litmus paper on CSGN is over to Bear and over to Lehman, clearly not accurate, clearly off the mark. How off the mark is it? What's the state of Credit Suisse versus our collective memories?
Well, okay, so one of the simplest things I did to kind of think about this today was look at the liabilities, the kind of the funding of Credit Suisse in 2007, Credit Suisse today, and Lehman Brothers in 2007. And that kind of helps to show you just how much things have changed. So, for example, back in 2007, Credit Suisse's sort of deposits and long-term debts was about 36% of its funding, and now it's about 75%. And if you look at Lehman Brothers, you know, totally the other way around, short-term funding and you know, trading liabilities, securities refinancing, all of that stuff, that was about 76% of their balance sheet at the time. So it's, I mean, just in that very, you know, forget all of the liquidity coverage ratios and net stable funding ratios and CET1 ratios and all of this modern stuff, you know, just in the simplest sense, the funding structure of banks today is completely different to how it was back in 2007, 2008.
So, Paul, perhaps that means that Credit Suisse isn't poised for some sort of imminent swoon, but certainly the price valuation that we're getting with respect to stock moves and in the CDS market are a lack of faith that makes it much more difficult for Credit Suisse to raise money effectively without further reducing their valuation. How much is this pushing Credit Suisse into some sort of acquisition, sale, something that means that Credit Suisse will no longer be Credit Suisse as we know it now?
Well, their preferred, you know, strategy to reshape the bank from the beginning, I think, has been to, you know, either find an injection of third-party capital, some extra money just to help fund the securitized products business, which they think might be more attractive to somebody else, to a different owner, or to find sort of assets to sell. And, you know, we've had stories about how they might sell some of the wealth businesses in Latin America, for example. I mean, I don't think even when they started looking at this, they thought that capital raising was one of their first options, going straight to the equity market. And as time has gone on and as people thought about the fact that they might want to raise some capital, which, you know, at the end of the day is to speed up the restructuring. It's not to kind of solve problems that they have today. It's to allow them to restructure faster. You know, as people have thought about the fact that that might happen, that's just hurt the shares more, and they're now like, what, 20% of book value?
Yeah.
You know, they're just in no position really to do it. I mean, they would have to be really desperate to come to the market at this point.
We were talking just now about the distinction between Australia's central bank and the U.S. central bank. What is the distinction between Credit Suisse and European banking at large? This question of, is it just an idiosyncratic moment or to its market and economy?
Well, I don't know. That's a tricky question. I mean, I guess the main difference between, I mean, you think of like the big German banks where, you know, the returns of the kind of ordinary lending and retail business that they do at home have consistently been very, very low for a very long time. And that's always made things like Deutsche Bank and Commerzbank much, much harder to turn around and much, much harder for investors to see as something very promising in the future. Whereas,
Well,
you know,
I've graded Paul at Davos asking this question to banker types. When do the European banks merge cross-border? Do you see any cultural newness to the idea finally we'll get like what we saw with Fortis a million years ago?
I mean, I guess that deal was born, you know, out of a different time. The problem is that, you know, European banking markets just don't work in a fluid way. It's not really a single market. It's very, very difficult to you know, put a bunch of retail banks together across Europe and turn them into a single bank that has real synergies and real savings and really kind of, you know, boosts the returns that you can get from it.
Paul, thank you so much. Paul Davies, writing for Bloomberg Opinion. Spectacular essay on Credit Suisse. He says, calm down, everyone. Mr. Davies, of course, with decades of experience there as well. Lisa, we stagger to 10 a.m. Let us review JOLTS, which is a real measurement two ways of the jobs market. Unlike claims, it's a two-way study.
How much are companies posting openings? How much they need employees? And what we've seen anecdotally is that a lot of companies are still hiring. Some are freezing, right? You see that from Facebook's parent company, Meta. They plan to be a smaller company next year. You hear this from a lot of companies, but on the peripheries, you're still getting a lot of postings. And I go back to July. We actually saw an increase on a month-over-month basis.
With the pandemic, and with the shock of the fiscal impulse and the savings rate, which is depleted, I get that and all that. It's just absolutely original labor analysis into Friday's jobs report. I mean, this is completely original from anything I've seen.
There have been a lot of people who've retired. There are a lot of people who are out of work because of long COVID. The uncertainties, the vagaries that are hitting all of these companies, having to be translated into some kind of policy by the Fed is not an easy task.
Are the retirees going to go back to work now that COVID drifts away?
I mean, a lot of people retired, so we'll see whether they come back in. I mean, this is the whole question. If they do, this is what they're hoping for that perfect landing, right? This is the soft landing, sweet spot, the Goldilocks scenario. They come back in, lower the wage increases, and we get back to normal.
I suggest that the retirees possibly will come back to work for any number of reasons. Not that I know about that, but you know. Futures up 58, Dow futures up 378. Put it together 2 days in a row. Up, in a way. Please stay with us on radio and television. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Today's CFOs are reshaping the C-suite, breaking out of traditional roles to become Chief Future Officer. Global logistics is complex. It takes plenty of capital and plenty of focus. Deutsche Post DHL Group CFO Melanie Kreis makes sure her company has both.
My role is essentially saying what is working well in this company, where do we have challenges, and what should we do going forward.
Chief Future Officer, Wednesday on Bloomberg. Brought to you by Workday. Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close. Weekdays on Bloomberg.
Yields down, stocks up. Live from New York City this morning for our audience worldwide. Good morning, good morning. Equities up big time, up 1.6%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, we begin with the big issue, peak everything, all over again.
All the conditions are there for a peak.
Peak yields.
The peak in bond yield.
Peak Fed hawkishness.
At some stage, there will be a peak.
The peak.
Can I use that word peak again?
You put everything together.
The fact that we have had 10-year Treasury yields break 4%.
Forward inflation expectations have dropped.
Inflation has peaked in the U.S. Growth is weaker.
There's a lot that is priced in at the very front end.
The bar is really high for the Fed.
We're certainly still seeing, some bond market revolt.
The markets are misreading the Fed and have misread the Fed all along.
That long bond is struggling to rally more.
Biggest bond market in the world should not have such weird kinks in the curve.
It's really hard because the U.S. data is strong.
It just feels like we still have a few more weeks of more shoes to drop.
We really need to see the data crack.
Joining us now to discuss is Exonic's Peter Cecchini, Cameron Dawson of New Edge Wealth. Cameron, straight to you. Peak everything. How many times have we done this and been wrong through 2022?
Yeah, we just did that back in June where we saw a near-term peak in yields. We saw a near-term peak in the dollar that led to a big rally in stocks and also the pricing in of rate cuts in 2023. And then what ended up happening is that as the yields and the dollar got back to their trend lines, what we saw is that they started rising again. And I think that is the risk here as we think about how long this rally in markets could continue from a stock basis, is that we will likely see yields go back to their trend after we had that kind of big blow off rally, but we don't see any signs of a trend break yet. The 10-year can go as low as 3.2% and still be in an uptrend.
The move we've seen in the last week is pretty clear. The 10-year yield is 4% last week, has gone down to 360. A 2-year yield at just north of 4%. It was 435 last Monday. Pete, I get it. Yields are lower. We've seen this movie a few times this year. Now, Pete, the question I'd ask you is, what did we get wrong through the few times we've seen this play out last time? And how do we know if we're right this time?
Well, I think there are a couple of things to consider here. The first is to the question, have yields peaked? We might actually ask, does that really matter at this point? Our thesis here at Exonic has been that we were close to peak yields, certainly at 4% on the 10-year, that we'd see a retreat from there, and that the next phase of the pressure on risk assets would come from earnings. And the damage, if you will, maybe that's the wrong word, but the damage to the real economy from hikes is just starting to occur. And the same, I think, therefore, can be said about risk assets, especially when you look at the riskiest of those, which are, for example, equities and perhaps speculative grade loans, which are two areas we're remain particularly concerned about. So where have you been wrong in the past? I don't necessarily think that's all that relevant to the, maybe everybody's calling for a peak. I'm not sure that's really the relevant question at this point. The point is, even if we have peaked, what's next? And I think the next leg down, the catalyst will be something very different from the rate move. And I think that's really important, that transition.
Pete, you're welcome to answer your own questions whenever you like. Marko Klanovic at JP Morgan had this to say: "We're growing increasingly worried about central banks making a policy error. While we remain above consensus positive, these developments are likely to introduce delays in the economic and market recovery, putting our 22 price targets at risk." Cameron Dawson, I think if you asked a lot of people for evidence of capitulation and they were snarky enough, they'd say, find me the biggest bull on Wall Street and show me that individual starting to crack. That's what we're starting to see with JP Morgan. What does that mean to you, if anything at all?
Well, I think that there is just a growing appreciation of what the real earnings risk is. Of course, from a contrarian perspective, it's good to see bulls crack and you start to see them throw in the towel. I think from capitulation, we still haven't seen that retail investor crack. We still have about 65% allocation to equities. It usually goes down to 40-45% during major bear market lows. But I think that when we look at what the real economic reality is, it is one where earnings estimates remain too high. We have lowered the bar for 3Q earnings. We're going into earnings season expecting just 3% growth compared to 10% growth earlier in the summer. But if we look to 2023, it's still 7% growth for next year. And we heard from Fed Williams yesterday talking about a pretty significant increase in unemployment. That is not consistent with earnings growing 7%. And so I think that's the economic reality that the market needs to come to terms with, kind of post these shorter term positioning and sentiment moves.
They have said repeatedly that it is too premature to even talk about ending rate hikes. They have said repeatedly they're committed to not prematurely easing back on rate hikes, and yet here we are again after the RBA only hikes 25 and not 50. We're having this conversation. Peter Cicchini, Ray Dalio of Bridgewater, speaking of capitulation, said this about cash. When the facts change, I change my mind. What do you do, sir? Quoting, of course, Keynes, goes on to say, the facts have changed, and I've changed my mind about cash as an asset. I no longer think cash is trash. Connor sent a Bloomberg opinion followed up by saying this, strange to wait until a 60-40 is down 20% plus on the year to say cash is no longer trash. Would have been a good flip about 10 months ago. Cash is trash. Well, it was maybe a long time ago. It hasn't been this year, Pete. It's outperformed in a massive way. What would you say to people that still want to stay there? They want to sit in cash?
I think it does make some sense. Look, the equity market, as you know, from the beginning of the year for us was not the place to be. We expected higher rates. I think it is interesting how so many big houses have pivoted recently. One notably from 4,300 on the S&P 500 to I believe 3,600. So we've been seeing a lot of that, and suffice to say, this is a hard job, and we can all be wrong, but to pivot this late, I don't think is very helpful to investors. Fortunately, we've been positioned very, very conservatively in the expectation for, frankly, what's been going on. Staying in cash makes sense because I do think the opportunity set will continue to improve throughout the course of the year. That said, and I'm going to answer my own question again, I guess, John, sorry. Breadth in the equity market has reached capitulative lows with, I believe it's well below 15% of the NYSE trading below its 200-day moving average. And so you're going to get these vicious bear market rallies that make it feel like a bull market when it's really not. So to answer your question, we still like cash, notwithstanding some of these vicious bear market rallies that are inevitably going to occur when markets get this oversold.
It's getting better. You're answering mine and your own. Futures right now up 1.5% on the S&P, and the Nasdaq 100 up by 1.9%. Just hearing from the Chancellor in the UK in an interview with GB News, a local broadcaster in the United Kingdom, saying the following. The Chancellor says the fiscal plan will be on November 23rd as planned. The fiscal statement will not be brought forward. There was some suspicion, speculation, reporting even, that maybe that budget, that fiscal statement would be brought forward ahead of the Bank of England rate decision on November 3rd. The Chancellor saying just moments ago it will not be brought forward, that it will take place on November 23rd as planned. I guess we'll see. Sterling rolling over just a little bit, not in a big way, still up 0.4%, cable 113.69. I'll pick up on that story in just a moment. Want to pick up on the Fed speak. We'll hear from Williams today, speaking right now, I think. The latest message pouring cold water on any hopes of easing off the brakes. Mike McKee has more. Mike, every single time we get a rally, we start talking about these guys backing off.
Yeah, and then we go down and then people start saying, well, they're going to have to raise rates higher because inflation is higher. You've been talking about it. If wish were father to the man, we would be at peak rates right now, at least for the markets. Investors have been looking for a sign of a pivot. They did get one today. Unfortunately for them, it's the Reserve Bank of Australia raising rates by only a 0.25 percentage point, seen as a dovish increase. Australian yields fell and U.S. and European yields also fell, continuing a mild bond rebound spurred by signs of slowing in their respective economies. The bad news, though, the difference is that Australia has lower inflation than U.S. and Europe and a heavily indebted population with variable rate mortgages that would be threatened by significantly higher rates. You mentioned it. John Williams and other Fed officials continue to make it clear they're not yet ready for a pivot here, barring a surprise collapse in consumer prices or a surprising drop in employment on Friday. The Fed still plans to raise 125 basis points by the end of the year. Williams saying yesterday tighter monetary policy has begun to cool demand and reduce inflationary pressures, but our job is not yet done. Still, as you noted, John, equities rallying along with bonds has people talking about a pivot again. Futures dropping significantly on their view how far the Fed will go after that. September 23rd futures pricing in a terminal rate of 4.7% by May of next year. Now 4.3, rate cuts starting after that. But that's still a long time away. A lot can happen. You look at the OPEC Plus meeting, everybody's talking about what effect that's going to have on oil prices and inflation. Williams emphasized that. Not just markets, not just rate cuts, but we're seeing a lot of volatility because a lot of things are going on around the world. He also noted you're still trading and the trades are working, so it's not a real problem yet.
Mike, one question I've asked is whether this rally makes it more likely, not less likely, this Fed goes big again.
I think the Fed is looking at it as markets go up, markets go down. They can't really control why they're doing that, especially with news continually breaking. So they'll look beyond it as long as people are able to trade.
Mike McKee, thank you. We're not going to talk about the RBA. The RBA getting so much attention this morning. I guess it speaks to the market move of the morning so far. Ed Yardeni of Yardeni Research was on with us in the last 24 hours. Take a listen to this.
I'm totally stumped, mystified, surprised that Fed officials don't seem to acknowledge that just focusing on the Fed funds rate as part of the monetary tightening cycle is a mistake when you also have QT2 and you have a soaring dollar. And these are very restrictive monetary developments. I think they got one more rate hike coming in early November, and that'll be it because the financial stability issue will pop up as primary concern.
Cameron Dawson, that line again. I think they will have one more rate hike in November. That will be it because the financial stability issue will pop up as a primary concern. Do you agree with that?
Well, that might be the case, but that doesn't necessarily mean that it takes the pressure off of risk assets, because the reality is that it's not just the destination, it's how long you stay there in very high rates and very restrictive policy, because that's what will really slow economic activity. If we think about all of the borrowers who are exposed to floating rate debt with LIBOR rates going from 0.2% to 4.8%, this will have significant impacts on their ability to hire, do CapEx. And so, yes, they might pause to see how things happen, but the longer they stay in that restrictive territory, the more we will see it impact the real economy. And so I don't know if that would necessarily constitute the kind of dovish pivot that would want to embolden you to be very, very long into risk assets at high valuations.
Pete, what Cameron just said is so important. A pivot, a pause per se, is not necessarily bullish if you're pausing for all the wrong reasons. Pete, your thoughts on that?
Yeah, I think she just answered my question of earlier more eloquently than I answered it myself. That was precisely the point I was trying to make. I think the lag with which monetary policy acts on an economy matters, and the longer we're at these high level rates, especially when we consider where we came from, what the economy had been accustomed to and what market participants had become accustomed to, a higher for longer, even if it's not accelerating higher, makes a big difference relative to how one needs to think about risk asset allocations. That's really, I think, the key point that everyone needs to think about. There's been a paradigm shift. We have inflation now. The Fed is not going to be able to, even if it's done hiking, which I believe it is very close to at the end of the year, maybe into early next, it's simply not going to be able to cut as rapidly as it needs to unless there's something disastrous going on.
Peter Cameron, sticking with us. Futures right now up by 1.5% on the S&P. It's a nice rally. Yields lower, stocks up, dollar weaker. Up next, the UK government making a sharp U-turn.
It was becoming a distraction, so that's why we immediately changed that policy, and that's the kind of government we are. We do respond when there are concerns, and we act quickly.
The fiscal issues in Europe coming into sharper focus. That conversation up next.
Okay, so you're moving in on me. Quick. Distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I'm not talking about common debt issuance or a recovery fund or something like that, because we know that it might raise some difficulty among member states. I'm just talking about the possibility at the national level to raise debt, but with the support and the guarantee of all European member states.
A little bit of division emerging in the EU amid a call for joint debt issuance. More hawkish member states, including Germany, pushing back despite criticism over its €200 billion borrowing plan. This coming as the UK makes a bit of a U-turn on its own tax plan.
It was becoming a distraction, so that's why we immediately changed that policy. And that's the kind of government we are. We do respond when there are concerns, and we act quickly.
No more distractions. We have a plan, and we need to get on and deliver it.
I'm prepared to do what it takes to get us through these difficult times, to get us through this difficult winter.
Exhausting stuff. Team coverage starts right now with Bloomberg's Maria Tadeo in Luxembourg and Lizzie Burden in Birmingham. Lizzie, first to you. There was some speculation this morning that maybe that fiscal statement from the Chancellor gets brought forward. What did we learn recently?
Well, the Chancellor, Kwasi Kwarteng, tells us that we were merely reading the rooms. I thought he was throwing a bone to the markets here because, of course, the lack of an OBR forecast, the Office for Budget Responsibility, when the official budget came out in the beginning, undermined the credibility of it in the markets. It wasn't just Bloomberg that was reporting it, it was also the Financial Times, it was according to government sources, but Kwasi Kwarteng says, after all, we are going to have to wait till November the 23rd. That'll be after the Bank of England's meeting on November the 3rd. And so the Monetary Policy Committee isn't going to be able to take account of the fiscal watchdog's assessment of how much growth this will stimulate. Kwasi Kwarteng seems to think that we were all fools here.
It's all our fault. Nobody else's. The UK, under immense criticism over the last couple of weeks. Maria Tadeo, I have to say, Europe's not been spared. Germany, with their own plans, and their own plans also being heavily criticised. Maria, what's the tone over there?
Listen, Jonathan, this is what 200 billion euros, when you put that on the table, can do to a continent that is facing a monumental energy crisis, but at the same time does not have the 200 billion euros that a country like Germany can spend. We know, and this is not a secret, the fiscal capacity is not even across the euro area. Now, the Germans are defending this plan. They say it is big, but so is the problem that we face. We do not want to create distortions, and this is not going to be an issue for the level playing field. But Jonathan, I can tell you, and I spoke with the French finance minister, Bruno Le Maire, who told me we do need coordination and we need a joint response. Now, this is where it gets technical, but I know you're going to allow me to get technical. Remember the recovery fund. This was unprecedented for the European Union. It was loans and grants handled by the EU. Now, what some of these countries now say is that they can live without the grants, but they want to see something that looks like backed loans by the EU because that would give them better funding rates. So this is where the debate rate is at. This is not going to go anywhere, especially as the winter crisis heats up, and you're going to see more countries say, we need a joint solution, we have to find it. And the French finance minister told me this is not weeks, it's days.
You can have as much time as you like, Maria. You know that, to get as technical as you like. Maria Tadeo there and Lizzie Burden. Maria, Lizzie, to both of you, thank you. Tremendous reporting recently. Peter Cicchini, Cameron Dawson back with us. Pete, I want to go to the energy story and fold in OPEC as well. OPEC Plus teeing up a big output cut. Just how bad are things going to get on the energy front, and for how long?
Well, I certainly don't think the worst is behind us. And in particular, there are two things happening into the end of the year that I think are important. The first is that seaborne sanctions for Russian oil kick in on December 5th, with the import ban kicking in early next year on February 5th. And importantly, and especially when compared to the stories on OPEC, the SPR releases end at the end of this month, and that is 1 million barrels per day that is for sale, that will likely not be coming back for sale, whatever OPEC decides to do. And so I think from that perspective, given that oil has become a substitute for natural gas in Europe, given how high natural gas prices are, oil prices will be moving higher into the end of the year, which is an important wrinkle in this idea that inflation is going to decrease and that the Fed will be able to pause. I think as energy rises, that complicates the picture for all central banks.
And potentially the economy rolls over. I think that complicates the picture for people in markets too. Cameron, it's a key question. I've asked it a number of times through the summer and into fall. Do I want to be long the energy names still going into an economic downturn?
Well, I think you do. First is because it's a great hedge in portfolios in the event that we see energy prices go up, gasoline prices go up. You could imagine that other risk assets would do rather poorly simply because those rising energy prices would lead to an increase in inflation readings and an increase in inflation expectations. Remember, gasoline prices are the biggest driver of both short-term and long-term inflation expectations when we look at that University of Michigan survey. So from a hedging perspective alone, it's valuable. But when we think about the demand and supply drivers, we're seeing that reduction in supply from OPEC. And then we're seeing the reduction in demand a possible increase in demand in China. Because we have to remember that China goes into this Party Congress in the next couple of weeks. They've been in lockdown with the COVID-0 policy. If that starts to be released, those 65 million people that have been in lockdown that aren't traveling around, and half of China's fuel consumption goes for transportation fuels, that could introduce an uptick in demand for oil, kind of regardless of what's going on in other parts of the economy, that could put upward pressure on oil prices.
My colleague Tom Keene has said this all year. It's just amazing, remarkable. We've seen this take place in the commodity market this year, with China still maintaining COVID-0. Peter Cicchini, Cameron Dawson, to the both of you, thank you. Futures right now at 1.6% on the S&P. Coming up in the morning calls and later, Hightower's Patrick Fruzzetti from New York. This is Bloomberg.
of a push have you seen from the Kishida government in terms of green funding? The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups and innovative companies in this space. What do you make of Kishida's new capitalism? Well, I think his framework is reflective of the challenges that Japan society is facing, namely that growth has been present, but growth has not been, of course, evenly distributed. But frankly speaking, it's hard to redistribute income if you don't have much income to begin with. If the government and private sector can work together and collaborate to drive more innovative growth startups, that can really drive the income growth that the Kishida government needs to redistribute.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Five minutes away from the opening bell, equities up by 1.5, 1.6% on the S&P 500. Equities up, yields lower, dollar weaker. That's the story this morning. That's some of the price action for you. Here are your morning calls. Let's begin. First up with JP Morgan naming Amazon its favorite internet stock, seeing a number of competitive advantages with the holiday season approaching. Citi upgrading BNY Mellon to buy, 46 price target, seeing limited credit risk and an attractive valuation. And finally, Wells Fargo downgrading Paramount to equal weight, growing increasingly concerned about the linear ecosystem across media. That is such a media line, isn't it? Paramount right now, 1962, unchanged in the pre-market. Coming up, energy stocks kicking off Q4 with their biggest rally in nearly 2 years. Hightower's Patrick Frizzetti expecting the outperformance to continue. That conversation is coming up next. Your opening bound just around the corner with futures up 1.5% on the S&P. This is Bloomberg.
Is there still room for Abenomics to be carried out in full in the way that Shinzo Abe imagined it?
The economic situation that Prime Minister Kishida faces today is very different from the one that Abe Shinzo was faced with when he became Prime Minister 10 years ago.
Does Japan need a new policy? Is that what Kishida has to learn, or are there parts of this that he should hold on to?
I think there are probably parts that he should hold on to. I think the main challenge which Japan faces is demography. The population is declining, rapidly aging. Women are totally underused in the labor force, especially educated women. One needs to think about increasing immigration. These are issues that Abe tried to address, but a lot more needs to be done to quote-unquote revitalize Japan.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer, like Marriott's Leni Oberg.
One of the most important things is looking around the corner.
Adrian Mitchell from Macy's.
We have to let go of the traditional legacy department store.
And Luca Zaramella at Mondelez.
We tend to believe that all consumers are equal. They are not.
Look for Chief Future Officer on Bloomberg. Everything you need to get set for the start of U.S. trading. Bloomberg The Open with Jonathan Farrow. Drilling down on the numbers and preparing you as only Bloomberg can. Weekdays on Bloomberg.
24 seconds away from the opening bow this morning. Good morning to you. Yesterday, a really nice pop on the S&P 500. We add some weight to it again at 1.6% on futures. On the Nasdaq, we're up 2 full percentage points on the Nasdaq 100 on the small caps. Not exactly leaving them behind. We're up by 1.8% there as well. That's the equity story. Switch at the board and get to the bond market. Yields lower as you might expect. We're down 3 basis points on a 10-year, off the lows of the session, but well off the highs of last week. Through 4% last week, last Wednesday. 360.72. This Tuesday morning, we're down 3 basis points. And the FX market, dollar, a whole lot weaker, euro stronger. Euro dollar 99.17, positive by 0.9%. Crude up 2.8%, up a little more than $2 to 85. And let's call it 90-something. The opening bow then, about 20 seconds in, with positive 1 full percentage point on the S&P 500. Let's get you some movers. Here's Katie.
Hey, John. Well, a lot of those gains are coming from Amazon.com, climbing after JP Morgan named it as their favorite internet stock by a wide margin. That is a direct quote. Analysts there cited Amazon's inventory advantages heading into the holidays. Amazon up 3.6%. You also have Bank of America climbing, just one of several big banks pushing higher this morning. That's even with a price target cut from Goldman and yields dropping this morning, but still Bank of America up over 2%. Moving on, we have Rivian also in the green after sticking to its goal to produce 25,000 cars this year. That means that Rivian has a market cap of $954,000 per completed SUV. For comparison, Tesla has about $425,000 in market cap per car, so make of that what you will. And finally, Poshmark, I've never used it, John, but the online fashion market, it's soaring after news that its Korean rival will buy it in a deal of about $1.2 billion. Shares up about 13.5%.
Is this when you sell your old designer clothes?
I assume so.
Is that what that is?
I mean, someone wants to buy it, so there you go.
I'll check it out. I'm sure Tom is incredibly active on there. Tom Keane, of course. Katie, thank you. On the S&P 500. 2 minutes in at 1.5% on the S&P. Every single industry group on my screen right now is positive, led by consumer discretionary, up by 2.7%. Talked a lot about where we've been in the bond market. Last Monday on a 2-year 435, on a 10-year last Wednesday north of 4%. Where we are this morning, big turnaround from there. Yields fading off the lows of this morning, but just compare them to last week still. 4.1% almost on a 2-year, 10-year 361. All the way down from 4% last week. It's a turnaround. Yields lower, stocks up. With more, here's Kaylee Lyons. Hey, Kaylee.
Hey, John. Yeah, that turnaround definitely applies to equities as well, specifically those very sensitive to rates. Just take a look at the home builders, for example. An ETF that tracks those names is higher by about 2.9% here at the opening bell, as you're seeing yields coming in once again today. You also have the financials getting a bit of a lift, and the ARC Innovation ETF, which of course houses stocks with really, really high multiples, those are getting a big lift as well, up nearly 6%. And this echoes the moves that we saw in yesterday's session. All of these groups were outperforming in the Monday rally. For the home builders, for example, they gained nearly 5% in yesterday's session. And you've got the utilities and banks and communications and software stocks all in the outperforming group as well. And of course, for software and communications, that all falls into kind of that tech basket. And I just want to spend a moment longer on those names because we know a lot of them are richly valued, more value placed on future profits, which is why higher borrowing costs have been so problematic for those names and have brought those multiples lower with prices going down. But as rates have come down, you're starting to see a little bit of catch up being played. And according to our colleague Jan Patrick Barnett and his analysis this morning, based on the latest moves we're seeing in yields, the NASDAQ 100 may have another 4% of upside. I will just end, though, with a word of caution, John, something you've noted throughout the show. We have seen a number of head fakes in the bond market over the course of the last year when it comes to that whole peak yields narrative. If we're not there yet, that doesn't necessarily mean that the tech stocks pain is over, John.
We've done it at least 4 times.
Yeah.
And at least twice in the last 3 months.
Yeah.
Kelly, nice, thank you. Kelly, thank you very much. I think we did it shortly after Chairman Powell spoke in Jackson Hole, maybe a couple of weeks later, and then we're doing it all over again a few weeks after we heard from the Federal Reserve. Just recently, I'm exhausted, you are too, I know. On the S&P, we're positive 1.9%. On the NASDAQ, we're up by 2.4%. Stocks rebounding after shedding $10 trillion in market cap through September, setting the stage for one heated debate on Wall Street.
Where we are in terms of capitulation.
The sign of capitulation.
That feel of capitulation.
We want to see capitulation.
You really haven't had that.
Getting those earnings expectations down is something that we really need to see.
Investors want to hear management speak.
See some companies rip off the earnings Band-Aid.
And really kind of throw in more of a towel.
If you're looking for panic.
Even though you've had as much volatility as you've seen.
You're not getting it yet.
The equity market probably has further to go down.
Taylor Ricks has more. Hey, Taylor.
Hey, John, and take a look at, well, at least yesterday, one trading day into the fourth quarter, and things look pretty good. That's not even counting the strength, of course, that we're seeing within a few minutes of the opening bell today. It is going to be, if you look at yesterday, the third best start ever to a fourth quarter and to October, and yesterday's 2.6% gain on the S&P, just about the sixth time that the market has added at least 2% on the first trading day of October, going all the way back since 1928. So you're getting a little bit of that bullish tone yesterday, and that continues into today. I want to be careful with the next chart, though, when we think about the Fed and rate hike expectations, because every time we think about a dovish pivot, the Federal Reserve comes out and says, no, that isn't going to happen. But at least you can see that expectations through March had been about 165 last month, and then of course today you get maybe only market expectations of an additional 125. So thinking again about a 75, a 50, and then a 25 through March, and just sort of how bullish, or well, I should say hawkish or not, this Federal Reserve is. So some of that playing into the equity markets as of late. I think when you think about capitulation, John, is it orderly or disorderly? Yes, it has been a grind lower, but it has been orderly. I've heard a lot about some liquidity issues within the bond market, but this is a market within the equity world, as you know, it's falling, but it's not panic and it's not disorderly with massive dislocations.
Apart from the gilt market and other pockets of fixed income. So, Taylor, thank you. I hear you. Taylor Ricks there on the latest. Looking forward to the close a little bit later. We're building to the gains of yesterday on the S&P, up 2%, on the Nasdaq up 2.4%. Yields are lower, though they are off their lows this morning, and the dollar index is a whole lot weaker. DXY, the dollar, down, weaker for a fifth consecutive session. Hightower's Patrick Frizzetti pointing out the risk for any further gains, saying the following: as the dollar strengthens, foreigners who need dollars or have debt in dollars sell their dollar assets, putting downward pressure on US equity markets. Patrick, I'm pleased to say, joined us right now. Patrick, let's start there. Walk us through the relationship between what's happening in foreign exchange and what we're seeing play out in risk assets in the US.
Sure. Well, you pointed to it. The dollar is weaker over the last couple of days, and the market has rallied. You know, when it strengthened, those investors globally, or even sovereign countries that are looking for U.S. dollars, sell their U.S. dollar assets, and that puts more downward pressure on equity markets here.
Is that durable market pressure, durable downward pressure, or something that exhausts itself pretty quickly?
Well, it depends. I mean, has the dollar peaked here? I don't know. I certainly don't think rates have peaked. I would not be long duration here. I wouldn't be long duration equity, you know, long duration equity holdings as well. So when I look at the broader market, I see, you know, the dollar weakening temporarily, and quite frankly, we're positioned, you know, in the energy space and the commodity space for the coming months.
Patrick, I'll pick up on the commodity story in just a moment. With regards to the bond market, that judgment call you just made, what are the assumptions that underpin that?
On the rate market?
Yeah, that we haven't seen peak yields.
Yeah, so when I look at broader commodities, again, you know, right now we're in a supply-constrained market. So I continue to see, we heard OPEC, you know, they're going to be speaking tomorrow. They're going to look to cut roughly 1 million barrels per day. So that's going to continue to support energy. When we look at gold, you know, again, just look at the dollar being down roughly 15% through today. Gold is down roughly 6%. On the year, I actually think gold has held up pretty well. If you look at gold in yen terms, if you look at gold in euro terms, it's held up. It's held up well. It's done its job. It's really provided a hedge against, you know, the risk of, you know, fiat currency debasement. So we still continue to like gold exposure here.
Patrick, I wanted to talk to you about cyclical exposure as well.
Yeah.
Still like energy. You like the rails. I understand from the rails perspective, there's more of a long-term story underpinning that, but talk to me about how you want to add cyclicality at the moment.
Yeah, so the rail space is sort of a good example of the fact that right now we're in a time where we're deglobalizing, right? So when we think of structural inflation, we look at deglobalization, we look at sort of demographics and the labor market, right? So who's going to benefit? So just look to a country like Mexico. They can still produce cheaply. So owning a Class 1 rail, like, say, for example, Canadian Pacific, they have rail lines all the way from Mexico up to Canada now after, their acquisition of Kansas City Southern. So we like that space. There's been a lot of consolidation in that space over the last decade. They're getting pricing power. It's an onshoring play, and they can move a lot more material, cargo, et cetera, using a lot while burning a lot less carbon. So I think it has a lot of structural advantages over the next 10 years.
And Patrick, what would you say back to people who say, why would I want to buy it here? I get the long-term story, I get all of that, but why would I want to buy it here before we've seen the economic downturn really gain momentum?
Yeah, because quite honestly, I don't think they're as, I think they're actually a little more defensive than people think. We're going to continue to move product, across different sectors. And again, when you have this onshoring play, that's a bullish tailwind. And then, you fold that into, compare that, dovetail that with where valuations are today, I think it's a very attractive situation.
We'll return to that call before the end of the year, no doubt. Patrick, thank you. Patrick Frazzetti there on the rails there, and where he's optimistic, more constructive on this equity market. Up next on this program, Meta dialing back growth plans in New York City as corporate America turns to hiring freezes.
The hiring freezes and the trading down to a lower level are appropriate. I think there's probably some concern in Q1 of next year. So I think we're kind of showing that things are slowing down. Order books are still not too bad, but clearly Q1 is a concern.
That conversation up next.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
My grandfather got into the mutual fund business because the average investor could not get a diversified stock portfolio, and it was too dangerous to put, your entire savings in just a couple of companies. So the mutual fund was created to give a diversified expert management at a reasonable price. Today, we have a phenomenon where companies are waiting much longer to go public. And so in 2000, the average company went public after 3 years. Now, companies are waiting 9 to 10 years because there's so much money available in the private markets. As a matter of fact, there are half the number of public companies that there were in 2000, and there's 5 times the number of private equity-backed companies. So just from an investable universe, you look at the private markets, and it's significantly bigger. So the question is, that return that used to be captured in the public markets is now captured in the private markets. But the problem, as you know, is you're really tied up for a long time when you invest in a private equity fund. And so trying to figure out a way to solve the same problem my grandfather was trying to solve, which is how do you bring those returns responsibly, the democratization of the private markets to the retail investors. And I describe it as a bit of like running with scissors. Scissors is a great tool if you use it appropriately. And so we're focused on trying to figure out responsibly bringing it in to the average investor.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
freezes and the trading down to a lower level are appropriate. I think there's probably some concern in Q1 of next year. Nobody ever wants to lay people off in the Thanksgiving, Christmas holiday period, and you really can't do a layoff till late January. So I think we're kind of showing that things are slowing down. Order books are still not too bad, but clearly Q1 is a concern.
Softer manufacturing data, softer than expected yesterday. The weakness starting to creep in. We're seeing it in corporate America as well. Meta closing one of its New York offices with more cutbacks looming. A spokesperson saying the following: "We are working to ensure we're making focused, balanced investments to support our most strategic long-term priorities." Taylor, that corporate speak drives me nuts. What's the latest?
I know, and I hear you, John, and I think the comments from Zuckerberg last week were really interesting, saying that he's looking at a company in 2023 that actually might be smaller than it is today. And you see that maybe coming from the pressure on top-line growth, as you have a company that's looking at what could be a 4%, maybe a 1% decline year over year in this quarter, and then that drops as much as maybe 5% on a year over year drop in sales and revenue next quarter. That might be peak, as then the company rebounds a little bit, but then still looking in the fourth quarter at what could be still a decline on top line growth year over year of about 3%. So all of those headwinds then lead into a company that's looking at maybe job openings that are easing, with the companies saying not layoffs, but maybe hiring freezes, and indeed pulling back on some of the New York City offices that I know that we had a great story out this morning talking about that, and just sort of rethinking, as you mentioned, some of those long-term priorities and balancing the investment versus the growth.
Taylor, thank you. I think the phrase Taylor used then is really important. Hiring freezes, not layoffs. And a line we've talked about repeatedly over the last couple of weeks is that you can't fire what you could not hire. So we're going to see this show up in jobless claims or show up in JOLTS, job openings. Job openings coming out a little bit later, and arguably that's what the Fed is shooting for, to get job openings lower without really taking a big chunk out of the labor market. Mary Daly speaking right now of the San Francisco Fed and saying the following: inflation has not gotten into the psychology of Americans. I guess that's the good news for them. Sees a lot of room to slow the labor market. That's what she's speaking to. Looking abroad as well, not just domestically, saying the following: the Fed is aware its moves affect the global economy. The global economy is having a tougher and tougher time of it. Can you imagine trying to put together a strategic reorg in a world like this one? Credit Suisse rebounding this morning from a record low. The spotlight on the company's restructuring plans amid concerns over financial health. On top of this story for us has been Bloomberg's Sonali Basak. Morning, Sonali.
Good morning, John. You're looking at Credit Suisse ADRs yesterday closing above where they closed Friday, and you're watching the shares also close higher in Switzerland. So yesterday was a bit of a blip in the radar, but that does not ease many concerns still on the horizon. There's a lot of calls here from Wall Street sell side on whether they should be moving up their strategy review, the announcement that they're supposed to be making at the end of October, because the stock is trading something close to a meme stock until then. If you take a look online, it's kind of incredible. You're watching crypto traders looking to buy Credit Suisse at its low, but at the same time, there's a lot of struggles ahead, and Bloomberg's Allison Williams pointed it out very craftfully, which is that until you have a sense of what a potential capital raise could look like, it's very difficult to figure out what that stock is worth today, because it's such an event could be quite dilutive. Listen, Credit Suisse is really trying to pull a Deutsche Bank here, potentially sell some assets, get rid of some businesses to help fill that gap in that capital raise. But let's play investment banker here for just a second, because it's not where Deutsche Bank was just a couple of years ago, where the market was still soaring high. Selling assets at these levels will be lower than whether if they started to sell just a year ago. They also have to drum up demand, and right now a lot of firms are very reticent to take on risky assets. So the types of deal making Credit Suisse could make in this environment could have to get very creative here to start filling that what analysts think is a $4 billion hole that they'll need to fund this restructuring.
Sonali, I think you framed it perfectly. Just nailed it. This is going to be difficult to achieve. What's frustrated me when it comes to the likes of Credit Suisse, the likes of Deutsche Bank, and I wonder if it frustrates you, that we keep benchmarking to Lehman, that it's either Lehman or it's okay. And there is something in between here, Sonali, and it's still not great.
If for no other reason than that these firms have become semi-utilities since then, right? They have the full faith of the governments behind them. But beyond that, John, you have this firm trading at, less than a fourth of its book value. Take a look across the European banking sector. Most of these firms are burning money and are also trading below their book value pretty steeply, and I think that's a pretty remarkable event to face.
Sonali, thank you. Looking forward to your coverage, as I've said repeatedly, through the next several weeks on this, into the end of the month when we expect expect to hear that strategic reorg, that big plan from Credit Suisse, and then in a few weeks' time you'll hear from JP Morgan, and we'll kick off earnings season as well. Equities right now up 2.4% on the S&P 500. Yields were much lower. I have to say that story's faded. The 10-year basically unchanged at 363. The 2-year, big move lower yesterday by about 17 basis points off the back of the ISM manufacturing number that came in a bit softer. A lot more going on than just that. 4.1% on a 2-year this morning. We're down about 2 basis points. Want to get you some sector price action, lift the lid on the equity market with more. Here's Katie.
Well, John, literally everything is in the green. That is true on a sector level and on an individual mover basis. There's only right now 3 stocks in the S&P 500 that are not in positive territory on the day. So no surprise when you look at the IMAP function on the Bloomberg, everything is gaining to the tune of 1.5% or more. And of course, you see at the top there some of those rate sensitive sectors still outperforming, even though we have seen things turn around in the bond market. The likes of financials up about 3%. Consumer discretionary also higher by more than 3%. Of course, big weightings in that index include Amazon and Tesla, some big tech names that are seeing some big gains today. When you take a look even further beneath the surface at some of the more isolated sectors as well, consumer finance, this of course has a rate sensitivity factor when it comes to mortgages. If mortgage rates aren't extraordinarily high, you may have more people looking to take out loans and buy a home. So that's feeding through to names like Zillow, higher by about 4% with about 20 minutes into the trading day. And then you also have some internet retailers higher as well. Part of this is idiosyncratic, the story with Poshmark being bought by a Korean rival for $1.2 billion. But part of it as well is just the broader risk rally we are seeing, the idea that if borrowing costs aren't as high, people may have more money to spend. So you're seeing Wayfair up about 7.4% as well. But again, John, now looking at the moves in the S&P 500, just one stock is in negative territory on the day, and that would be Dollar General.
There we go. I think that speaks volumes at the moment we're in. At the moment, at least. Let's see how long it lasts. Katie, thank you. This from Mary Daly, the San Francisco Fed president. A narrow path to a soft landing, but it's not closed. Every time we get a rally, we end up having the same conversation. A Fed pivot. The S&P 500 up 2.4%, the Nasdaq up 2.8%. And to be fair, if you compare where we're priced in the terminal rate now compared to last week, we've come in about 30 basis points. That's material. That speaks to the readjustment in the equity market. Whether the Fed's going to pivot or not is a separate debate, and whether the Fed is pivoting for bullish reasons is a very different conversation as well. Up next, the trading diary from New York. This is Bloomberg.
Vietnamese consumers are very aspirational. You've got millions of people riding motorbikes, and they want to be riding inside cars. Vingroup, Vietnam's biggest conglomerate, has really tapped into that. The founder and chairman aspires to be the Elon Musk of Vietnam.
Vuong is Vietnam's richest man with outsized ambitions. He wants to sell cars not only to the Vietnamese, but also Americans and other consumers around the world.
If VinFast is successful, that goes very well with the ambition of the Communist Party of Vietnam. But if they fail, it will be very, very hard blow to Vingroup and also to the national economy.
The reality is, though, that interest rates are set by the Independent Bank of England.
They make those decisions on the basis of what's happening with inflation and other factors. The energy intervention that we have done is likely to curb inflation by up to 5 points, so that has a positive effect. But ultimately, what we're seeing around the world in the wake of Putin's war in Ukraine is interest rates rise. So the Federal Reserve, for example, has pushed up interest rates. So we will do, what we can to support people, but ultimately it is a decision for the Independent Bank of England.
Of course, the first mission of the new management of EDF, Luc Rémont will be at the head of EDF, is to have those 12 nuclear plants being reopened as soon as possible. I mean, by the beginning of 2023, we want all these 12 nuclear plants being reopened, because there is a need for nuclear plants and there is a need for nuclear electricity.
It's a difficult time in Europe, and it might not be just for one winter. It could continue for a number of years. Speaking to a number of energy experts, equities right now up 2.3%. The gains continue on the S&P, on the Nasdaq 100 up by 2.6. The gains continue even as the move in the bond market fades. 2s, 10s, and 30s yields were so much lower. Now basically unchanged on a 10-year, 363.49. Your 2-year, 4.1%. With that in mind, we'll see if these equities gains stick, if that bond market carries on moving in this direction. That's the price action. Here's your trading diary. First up, durable goods and jolts. Coming up the top of the hour, President Biden delivering remarks at 3 p.m. Eastern. Busy stretch of Fed speak continuing with Daly again this afternoon, followed by Bostic on Wednesday, plus OPEC meeting in Vienna. And finally, the U.S. payrolls report is coming up on Friday. I can tell you the estimate right now on payrolls, 265 in our survey, down from about 315. From New York, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
Just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Innovation, money, and power collide in Silicon Valley and beyond. Bloomberg Technology with Emily Chang. Weekdays at 5 p.m. in New York and 2 p.m. in San Francisco.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election.
Connection lost.
Racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we had mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard, In America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113 also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. and it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking, the bus was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venergold as an opportunity to leave that troubled home. Venergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Venergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Gold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Gold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data.
Connection lost.
NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I'm interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance, is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities and the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing
called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people want to unpack that. And so my audience is a lot of them are younger investors who are looking to hone their skills.
Tech in right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just attacked that video and were like, you explain things so much better than my boyfriend or my professor, or I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly, this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwist, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, The hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price, before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally miles, a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. But while that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.
Historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the center of the knowledge. Once you are born into a caste, it is very difficult for you to grow beyond that. You are stuck in that identity. I think education is the best way of liberating them. So that's how I chose to work in education sector. The kind of education that we are giving to the marginalized people is going to change not just the fate of these communities in Telangana, but it is going to be the source of inspiration, source of hope for all the marginalized in this country.
Greatest blight in India is the system of caste.
For generations of Indians, the social code known as the caste system has defined how people earn a living and whom they marry. Although outlawed 7 decades ago, castes remain a significant factor in deciding everything, from family ties and cultural traditions to educational and economic opportunities. Dalits, people who are on the lowest rung of the caste system, constitute almost 1/5 of India's population of 1.3 billion. Not able to afford the high tuition of private schools, many are forced to attend government-funded institutions, which in the past have suffered from poor infrastructure, lower education standards, and high student-to-teacher ratios. But Dr. Praveen Kumar is trying to change that.
I am currently working as head of Telangana Social Welfare Residential Schools. So totally above 400 schools I manage. These are all residential schools for the students who are historically marginalized but talented and then poor. Of them, 60% are girls and then 40% are boys, because girls are more marginalized among the marginalized. Their voices are always suppressed. My approach to improve the conditions in the schools has been put your eyes and ears on the ground always. Talk to the parents, talk to the teachers, talk to the students, stay in the schools and then understand their problems, their challenges, both in classrooms and then the corridors and the dorms. Then go to the dining halls and see what kind of food they are eating, and then go to their homes and then what kind of food they are getting and what kind of challenges the parents have. One of the important changes that I brought in after I took over was to complete the transformation of mother tongue to English medium, because English medium, as I said, English is the language of emancipation, a language that connects you to the whole body of knowledge in the world. So we had to train a lot of teachers.
Refer to the dictionary also, okay, and find out the new meanings. As well as you're going to describe about... Hey, Richita, how are you? Hi, Sindhu. Fine, thank you. And how about you? I'm fine too. It's been a long time.
Identity is extremely important. There is a scientific evidence to prove that your sense of identity is extremely crucial to your growth as a successful human being in your life. If you accept an identity which is very humiliating, which reminds you of very painful past, I think that identity will not help you to grow. I'm not saying that you should forget your past. I'm not saying that, but that should not be the bubble in which you must live always. Sweros is an alternative identity. S stands for state, W stands for welfare, Aero, SW and then Aero is Swero. So the idea is your dreams have to be skybound. So that is what we are trying to achieve by changing the identities. Like, you say, I'm a Swero and I aim to be a doctor. I am a Swero, I aim to be a top-notch engineer. I am a Swero, I aim to be a top bureaucrat of this country. I'm a Swero, I want to be a very good actor or, a musician in this world. So these are the positive images that are associated with the identity. Just to give an example to you, in 2012, in our institution, we used to produce about 6 doctors per year. But because of our, this self-liberating ideology of Sveroism, we have, this year, we have produced about 189 doctors. This is phenomenal for any poorest of the poor people. You know how difficult it is to get into medical colleges in this country. So, but today, because of this ideology, the students have been able to achieve this, feat. Pujita has been a farm laborer, and her parents themselves are agricultural laborers. And then this girl used to sell vegetables, but thanks to the residential education institutions, she came to the